Aside from tech then, how else do you play an S&P sitting in a record when volume's still low, you have less stocks making 52-week highs? What do you do?
So this goes back to valuations. And in fact, because earnings have run by so much, PEs, price earnings, right, have actually gotten more attractive this year, irrespective of the rally. So in fact, we're sitting at about 16 times forward PEs. That's the 25-year average. So despite what has been an astronomical rally since the bottoms, PEs are certainly attractive.
So you have to pair that, though, with what's happening with the yield curve and the question of, are we going to be headed into recession if it inverts? So the San Francisco Fed had a great note out yesterday saying, look, there's no clear evidence in the data that this time it's different, or that forecasters should ignore part of the current yield curve flattening because of the presumed macro financial effects of QE. We're all saying there's structural effects that are going to invert the yield curve, so no biggie. How do you look at it, and how does that affect your investment view?
Yeah, Dr. Yield Curve is supposed to be the best predictor of
So's Dr. Copper, but that's up for grabs too.
So we got this question a lot, right? We're so close to inversion. Just first of all, I don't think there's really anything wrong with folks getting a little bit more cash, interest rates in their cash accounts, and mortgage rates still staying very attractive. So if you just look at that dynamic from a financial conditions perspective, that's still accommodative for the U.S. When we look at the yield curve, though, there's one thing that really catches our eye. The ECB is in absolutely no rush, right? They just told us last week, and that's been the big miss this year. And if Bund rates stay at 40, of course, if Japanese government bond rates stay at 0, it's going to be really hard to get the U.S. 10-year much past 3%. So we are not looking at it something sinister of the yield curve flattening because of that fundamental story that I mentioned.
It's like at this time it is different. It feels like that's what you're saying.
But the question is, if you're putting together a portfolio or managing a portfolio, you can get two very different signals. It's basically the yield curve telling something about the ECB, and they're being slow, as you just said, or is it saying something about really prospects for longer-term growth? That basically the markets don't believe the growth is sustainable. And it doesn't mean you're going to get out of stocks right away, but there's sort of a timeline.
Yeah, David, that's a good point. And for us, it goes back to the long end being driven by two important things. The first is foreign demand, which I mentioned. The second are inflation expectations, which tie into your growth forecast. The Fed has gotten inflation to 2. There is really no one saying beware of higher inflation. And until that happens, we think the yield curve is going to stay flat. And that's a really nice environment for taking risk in the U.S.
So what point would you then get more defensive?
So it would be some of the more high-frequency stuff, jobless claims, housing permits in the U.S., confidence measures from both businesses and consumers. All of that stuff is staying really resilient and strong. Until that stuff starts to turn over, we're not taking a signal from the yield curve.